the Snowball Effect. Now, little did you know that with just time, you could become one of the richest men in the world, and that is exactly what Warren Buffett did using the snowball method. Today, we're going to cover the Dividend Snowball Effect and how you could expedite your wealth over time. Now, don't get me wrong, I'm a strong believer in having growth stocks and dividend stocks, but I think a healthy balance between the two will show you just how something so small can become something so large and start working for itself and let you retire at a very young age, or at least drastically reduce those years in the cubicle. So today you're going to learn, or at least re-emphasize, just how crazy dividend investing can be. And of course, this is over the long term. So today I'm going to show you guys multiple ways that over the past 20 years, you could have become a multi-millionaire with just a small initial investment. Now, just to make sure everyone's up to date, I'm going to give you guys a few terms that you're going to need to know in order to completely understand the method on why many billionaire investors use this. So the first word you're going to need to know is annual dividend yield. That is simply the yield that the company is paying out in dividends each year compared to their stock price. Expected annual dividend increase. This is simply how much their dividend is increasing over the years. Expected annual share appreciation. This is how much the actual stock price is going up over the years. And finally, what DRIP is, dividend reinvestment plan. Simply put, this means every dime that you get from your dividends, you are re-putting into the company and therefore getting free shares. So guys, let's get right into the video. So I think the only way to show you this is using real world actual things that have happened in the past and that could happen in the future very easily. So to really show that this is possible with anything, I'm going to show you one of the boringest stocks out there, and that is Lowe's home improvement store. To really put this into perspective, we're going to go back 20 years to March 2001 all the way to present date. And over that time, we've seen share appreciation of 1,074%. That represents a 53.7 increase every single year if you were to annualize that. So that shows a lot, considering this stock hovered from around $10 to $20 for about a decade, all the way till the 2011. Once we got out of the recession, we saw a huge surge up, and that's where most of this wealth has gone up. The next thing to look at is, of course, the dividend yield. Currently right now, Lowe sits at a 1.4, and at the time of 2001, this thing sat at a 0.18 dividend yield. And the last thing we need to be able to put some numbers in so I could show you how this small investment can become hundreds of millions of dollars. And that is the dividend growth rate. We can't go 20 years back, but it is even better if we go 20 years back. We'll just go conservative here and look at this 18%. So now I'm heading over to marketbeat.com/dividends. This is a calculator you guys can use to play with yourself, and you will see just how crazy this can be. So for the sake of this, I'm going to say you guys have $0 to start out with. You are broke. Now I'm also going to assume that you could put $1,000 a month into this thing, $12,000 a year. That's a lot of money. But if you're trying to retire early, you got to make some sacrifices while you're young. So when you're older, you can retire at the age of, if you're 25 right now, 45, 50, you could be retiring off of a boatload of money. Dividend reinvestment, you obviously want that on. That will make it so if you get a dividend for $2.30 every year from Lowe's for one share, it's going to buy another portion of a share. And then the next year, you will get even more in dividends because you now own more shares. This gets way better as you get growing and the snowball gets rolling, but we'll get into that in a second. Second thing is dividend tax rate. So the dividend tax rate is, if it's long term, it's about 15%. So you could put it at that, you could put it higher, whatever you want to do there, but it's going to have to be in a taxable account if you want to retire before the Roth IRA age or the 401k age. These are the numbers we got straight from Lowe's, and these are very incredible numbers, but you can easily find the next one. You could find the next Lowe's, maybe not 50% annual share appreciation over the next 20 years, but it's possible. You never know. So for the annual dividend yield, we did 1 because that's as low as this website goes. I can't do 0.18, but it is going to be roughly the same, maybe a little bit lower than what I get. Second thing is annual dividend increase. This is a little low. It would be higher if we went all the way back to 2001, but we can only go back 10 years. So we get 18. Hopefully that makes up for this part. Annual share appreciation. This is where we get the crazy 50, and then 20 years invested. Now, when we hit calculate dividends, you're going to see a lot of numbers, including your ending balance of $181,856,899.32. Now remember, this is one of the best performing companies over the past 20 years. So these numbers, I don't expect you guys to be worth 181 million over the next 20 years with only putting 12,000 a year. But if you do find the right stock, this is very possible. So let's look at this chart here just so you understand how the snowball gets rolling. It starts at $0 and you're putting in once a month, and by year 2, you're going to have $12,000 in your account, and your dividend will be $142. And this is your yield. This is your yield on cost. The next year, you're going to put another $12,000 in, plus you also received received $422, which equates to however many shares you could buy. And now your yield on cost is 2.65% because of these dividends don't count against your yield on cost. By year 4, you're going to have 57,000. So that is all of your money that you've put in so far, which would be 48, plus all dividends you've received, plus share appreciation. So you get all of these things working for you, and the snowball really starts to roll. So we go all the way to year 10, and your account is now worth $1 million. And what's crazy about this is you've only put in $12,000 for the past 10 years, which is $120,000. This gives an annual dividend of $44,400. Now remember, during this whole time, we're not taking any of this money and buying anything stupid. We're putting it all back into Lowe's or whatever company you choose. And the next year, this number shoots all the way up to $1.5 million. Now here's when this 1% starts getting really skewed, and you could see that the yield gets a little out of whack, but you get the point. The wheel really starts rolling at about year 10, as long as you pick that one stock that is the big grower and the big dividend increase king. Or in Lowe's situation, they've been paying dividends for 57 years straight and increasing the dividends for 57 years straight. Now, assuming you don't even pick the best stock ever, as in Lowe's, or you pick about like 20 stocks and some of them do well, some of them don't do as well, and some of them might even go bankrupt for all we care. We're going to use the same monthly amount. So to put the yield straight, we're just going to keep this at 1% because that puts us in companies that I think have the best chance, because we want to keep dividend payout ratio low, dividend increases high, and annual share price increases high. 1% gives us about Microsoft numbers. I think they're at a 0.98 right now. And companies like that increase their dividends at about 10% a year on good years, 10 to 20. As for share price appreciation, we're hopefully picking stocks that are leaders in their sectors, so I'm just going to give it a good annualized rate of 14%. Now I'm taking into account for like stocks like Apple, Microsoft. They have years where they're up 30-40% in the bullish markets, and then in the little dips they fall even harder, and they only have increases about 3-5%. So I'm just roughing it out about 13-14%. You can change these all how you see fit. So when I hit calculate dividends on this, putting $1,000 in every single month, we have an ending balance of $1.5 million. Our annual dividend income is $107,000, and we now have $107,000 coming in passively from a very conservative investment. Now we could play with the numbers all we want. Say you want to put $2,000 in every single month for the next 20 years. You know, we could play with the numbers all day and we'll get drastically different numbers. Or we could say we're going to work another 10 years and then we get really drastically numbers. But regardless, you get to pick what you're going to do in your life. So now I'm going to show you guys how to pick the stocks that are best for this strategy. So I'm just going to go over my criteria and keep this very short and very sweet. The first thing I'm going to look at is the dividend growth. How long have they been growing? A tool that you guys could use is seekingalpha.com. If you type in something and go to the dividend scorecard, it will show you how long they have been consecutively improving their dividends. The second thing, of course, is to share generally on a uptrend. The company needs to be on a long-term uptrend. They need to have a bullish outlook on it for the next 20, 30 plus years. So this could be companies that are retailers like Walmart, Costco, Target, Lowe's, Home Depot, or even a more upcoming company like Starbucks. And finally, the yield. We need a higher yield because this strategy is very, very determinant on your DRIP, dividend reinvestments. If you don't do this DRIP part, you're going to end up with a way lower number. You can test this on the website I showed you guys. But as long as you're consistent and persistent with this strategy, which is the hardest part about even starting in this strategy, you have to be disciplined enough to put aside $1,000 or $500 or whatever you decide to put in, and do it every single month, no matter if it's in a bullish market, in a bearish market, and you have to stay strong through the ups and the downs. If you can do that, I guarantee in this world, you will have success. And I really hope that I change your mindset a little bit on dividends, and hopefully you start a dividend account today. So guys, I hope you have a great one, and be sure to check out the channel and stay tuned in the channel for more dividend investing